Hi, welcome to Market in a Minute. So, if you watched the Denver Broncos game yesterday from Denver, right? I live in Denver. It was a lot worse than what it looked like on TV. I couldn't believe it looking out the window watching the game, how bad it was, how bad it got. So, if you're a tennis player, you'll understand this. So, we think that the markets are in no man's land. So, what's no man's land? It's from the baseline to the service line, that box that's kind of right in the court, and you're too far in to hit a good ground stroke, but you're not far up enough to hit a volley at the net. So we think that the market's kind of in this no man's land zone where, we had this rotation into value and small cap and cyclical stocks, and that was beautiful. And then growth kind of lagged, but we need interest rate cuts to continue to have this rotation. We either can go up to the net and hit some more volleys there, or we have to retreat back to the baseline and rely on the growth companies to do it. So we think that going through the year, we're going to get good fiscal policy, and that's going to show up in the latter part of the first quarter. And we're going to get interest rate cuts will probably occur after Powell's out of office in May. So we're kind of in that no man's land area where we don't have a good shot to hit because we're not in the right spot in the court quite yet. So we need to run to the net or we need to step back to the baseline. So we have two quality growth stocks to look at, software companies before earnings reports hit. So we like these. We think that they're quality and good value at this point. So a couple of companies that, we're back at the baseline hitting these, but I'll go through them with you. So here's the disclosure. Read at your own leisure. The stock market update. So on Wednesday, we had the Federal Reserve meeting, and there's nothing going to come out of it in terms of anything material, but we want to see what Powell says about inflation. I know he just watches the numbers. There's no sort of forward looking on his part, but I think it's time that he does because oil prices are way down and you have housing prices coming down or at least leveling out in most markets. So here in Denver, my daughter's looking for a house. She says that on the lower end, right? She says that the house prices are imploding around Denver. Granted, they are coming down, and from the really, really high point, they've come down very nicely. So we think it's happening nationwide. So Denver's a little unique. We had all these Californians come in here wanting to smoke pot, because it was legalized and drove up the housing prices. Now, that boom's kind of over. We think that they're coming back down to more reasonable levels, and probably that's the trend nationwide. So we think inflation will be nicely under control and should allow the Fed to cut rates a number of times as we go through the year. Now, everybody's talking about the dollar being so weak. So here's the long-term chart of the dollar. It goes all the way back to 2007, okay? So it got to a low in 2014 on this index, the UUP, of about 21. And it got up to a high, this wasn't long ago, in 2005, 2025, around 30. So at the end of 2024, around 30. It's now at 27, so it's pulled back about 10%. So people are getting a little bit freaked out that the dollar's weakening. But in the general long-term picture of this, it's still at the upper end of the range. It could come down quite a bit more. It could come down another 25% to go back down to the 2014 level. So we're not concerned about the dollar being a reserve currency, about all this money flowing out of the dollar into maybe gold or Bitcoin. We're not concerned about that, but we just think it's in this normal band, and you're just having maybe some central banks putting money into other assets rather than just the dollar. But we think that the dollar is just fine. Now, Bitcoin down 30% from the high. That's a a big decline, bear market decline, but it's up so much. We don't think that's a lot of value, intrinsic value to Bitcoin. Anyway, gold up 4x from 2014. So if you go all the way back to 2014 at 4x, that's clearly outperformed the dollar, right? And a lot of that's come very recently. This is a 5-year chart of gold. Gold's up nicely, up up about 160% or so from that point. So at $5,000 an ounce, gold is pretty highly valued versus what it costs to get it out of the ground. So we think it costs about $1,200 to get gold out of the ground. At 5,000, we think the gold miners are just going to be cranking out gold as fast as they can. Those are beautiful margins. Silver, okay, silver shot up in a big way. So I had people call me about buying silver. How do I do that? SLV is a good way of doing it. So silver up about 3x over the past 5 years and up, quite a bit very recently. We think what's driving silver, there is some industrial use for silver. So silver is used for data centers to conduct their electricity. Does it better than copper. Silver, it costs about $20 an ounce to get out of the ground. It's currently around 109, 110 an ounce. So it's more profitable to get silver out of the ground than it is gold right now. The margins are a little bit better. There's a lot more silver out there too. There's 19 times more silver reserves than there is gold. So I think, silver is not, in my opinion, a high quality precious metal. Gold is. There's less of gold. And so we think silver over time, I don't know how high this is going to go. It could go higher. If you buy silver, for God's sake, put a stop loss in there, because it could correct quite a bit. So there's plenty of silver to be mined, but the demand right now is outstripping the supply. Now on Wednesday, okay, this whole week and next week and the following week, we get a lot of earnings reports. On Wednesday, we have Microsoft, Meta, Lam Research, Tesla, and ServiceNow. And there's more, right? IBM and a few others report that are technology related. So Wednesday is going to be a very busy day, and we're looking at ServiceNow. We think ServiceNow's got some potential. It's pulled back quite a bit. Here's ServiceNow. Okay, ServiceNow is down about 50% from its high. The whole group is down about 20%. So the software companies tend to be high quality, but the stuff that's been impacted by AI really has been taken apart. Adobe, as an example, has really been hit by AI. So the valuations of the software group got as high as, for some, as high as 20 times revenues for some of those higher quality, faster growing companies. Now it's more like 10 times. So that's what ServiceNow is valued at. 10 times was 20 times. We think this is a good company. They actually benefit from AI. I don't know if you've seen their ads on TV. We will implement your AI strategy for you. And then Salesforce, we think that's a high quality company that's got a little bit of an AI play to it. It's pulled back tremendously. We think both companies are very interesting. We think ServiceNow is set up a little bit better. We would own probably both going into their quarters. ServiceNow technically looks really nice. You got all these moving averages to break through over time. So if this thing takes off, you're going to see buying pressure occur as it breaks through these moving averages. We think that there's upside to the earnings estimates at ServiceNow. So we think they're going to report a better than expected quarter. That's our view of it. That's our work. That's what it says, that they're going to have a better than expected quarter and expect this oversold stock to potentially lift nicely. So there's at least a trade in here that we think, and maybe it's a longer term holding as it's going to grow much faster than the overall software group, and the software group's been under pressure quite a bit. So if If you have any questions, come to my website, Patrick Adams CFA, or ping me off the video as well, or come to PVG Asset Management where I work, and you can sign up on either website to get a hard copy of Market in a Minute. We'll send that to you every week. And just remember, we're in no man's land. There's not a great number of good shot on goals, really. So we're looking to either rotate back to the growth companies or move forward, more aggressive shots at the net with the small caps, cyclicals, and value companies. So we think as we go through the year, we're going to be moving back into up to the net for some easy shots that are long overdue. Take care.